Have you wondered how China's automakers' price war and overcapacity are impacting their finances? With over 23% of Chinese industrial firms losing money by late 2024 and brands like Neta collapsing in Thailand, things are heating up. BYD's profit margin grew from 1.7% in 2019 to 5.4% in 2024, yet its stock just fell 20% after massive price cuts. Are these bold moves genius or desperation? And what happens when China's cheap cars flood global markets? From Thailand's EV crisis to Russia's tariffs, the ripple effects are real. Curious where this all leads? Hit subscribe so you don't miss what's next. Because this isn't just about cars, it's about survival in the world's largest auto market. Why are electric cars so cheap in China lately? Well, it's not just luck. China's auto industry is stuck in a brutal price war that began back in 2023. Overcapacity is a major cause. Factories are building way more cars than people are buying. Regulators in China recently admitted this is hurting long-term growth. China's leaders pledged in July 2025 to regulate extreme price cuts and gradually phase out outdated factories. But can they control such a massive industry? Here's a key fact. 33 listed Chinese automakers have seen worsening financial health over the past 6 years. According to LSEG data, the average time car makers took to pay suppliers stretched from 99 days in 2019 to 108 days in 2024. Why do you think they're taking so long? Because cash flow is tight. A new law from June 1st, 2025, now requires large companies to pay within 60 days. Jorg Wutka of DGA Albright Stonebridge Group called this law a level playing field. Will it help smaller suppliers survive? Now let's dive into some hard numbers. Have you ever had to wait months to get paid? BYD took an average of 127 days to pay suppliers in 2024, up from 81 days in 2019, and that's better than some. Geely's payment period hit 193 days in 2024. Can you imagine running a business and waiting over half a year to get paid? Interestingly, Great Wall Motor shortened its payment cycle from 115 to 94 days over the same period. Why do you think they managed that while others fell behind? Inventory levels tell the part of the story. Across China's auto sector, inventory has more than doubled to 370 billion yuan, 51.55 billion since 2019. Isn't that wild? Debt's rising too. Total debt jumped 56% to 959 billion yuan, and the median debt-to-equity ratio is now 51.3%. The median net profit margin is barely holding on at 0.83% in 2024. Does this sound sustainable to you? Let's break down who's surviving this storm. BYD grew its profit margin from 1.7% in 2019 to 5.4% in 2024. Impressive, right? That's because BYD's business now relies more on automotive products. 79.4% of revenue now comes from cars, up from 49.5%. Meanwhile, NIO and XPeng have some of the longest payment periods, 223 days and 237 days, respectively. Both brands promise to start paying suppliers within 60 days, but will they follow through? Car sales jumped again in June 2025, up 18.6% year-on-year. EVs and plug-in hybrids now make up 52.7% of total sales. Have you noticed more EVs on the road lately? Yet, BYD's growth slowed to 11% in June from 14.1% in May, and Li Auto's sales fell 24.1% last month. That's quite a drop. What do you think? Is this just a bump in the road or a sign of bigger trouble? Let's keep moving. There's more to unpack about this price war. Now, here's where things get intense. On May 23, 2025, BYD slashed prices on 22 models, some by over 30%. That's like walking into a store and seeing everything on clearance. Why did BYD do this? To clear out massive inventory and stay ahead. But it backfired. BYD's stock fell around 20% as of July 2025. Stella Li, BYD's EVP, called it very extreme and not sustainable. Why would a company admit that? Because this isn't just about selling cars. Suppliers are feeling the pain too. In 2023, BYD averaged 275 days to pay suppliers and used promissory notes worth over 400 billion yuan, $56 billion as collateral. In June 2025, both BYD and Geely promised to pay suppliers within 60 days. But can smaller suppliers survive long enough to see that happen? GMT Research warns BYD's real debt could be 323 billion yuan, 44 billion, 10 times its reported figures. What's your take? Is BYD a strong leader or just hiding deeper problems? Let's dig deeper into how this affects the global scene next. Liking the flow? Subscribe now. We're just getting warmed up. Here's something a lot of people miss. China's auto troubles aren't just local, they affect the world. How? Because when China can't sell cars at home, it floods other markets with cheap exports. China's trade surplus hit nearly $1 trillion in 2024. That's double 2019's level. Do you see this happening in your country? Countries like Canada, India, and Mexico are feeling it. Russia imposed tariffs on Chinese cars after they captured 2/3 of its market. Even Europe's solar panel and steel industries are under pressure from cheap Chinese imports. And it's not just products. Practices like zero-mileage cars registering unsold vehicles as sold to collect subsidies are distorting sales data. That's led regulators in Beijing to crack down on subsidy abuse. Here's a thought. Would you buy a new car knowing it might have been counted as used before you even touched it? These aren't isolated issues. 23% of Chinese industrial firms operated at a loss by the end of 2024. Can this system hold? Let's see what's happening in specific markets like Thailand. Let's shift focus to Thailand, where China's EV troubles are hitting home. Chinese EV brand Neta entered Thailand in 2022, but now struggles big time. Under Thailand's rules, companies must match imports with local production. But Neta failed, leading Thailand's government to hold back payments. Have you ever heard of dealers suing an automaker? That's what's happening. 18 Neta dealers in Thailand are claiming over 200 million baht, $6.17 million in unpaid debt. One dealer even said, "I stopped ordering more cars in September because I sensed something was wrong." Neta's parent company filed for bankruptcy in China last month. Do you think this collapse is just about one company, or is it part of a bigger pattern? In 2023, Neta held 12% of Thailand's EV market. By 2025, it's down to 4%. Meanwhile, BYD dominates with 49% market share. Smaller brands just can't keep up with BYD's scale and price cuts. Thailand still wants 30% EV production by 2030. Will they get there with this much instability? Here's the big question to end on. How many Chinese EV brands do you think will survive long-term? According to Alex Partners, only 15 out of 129 brands will still be financially viable by 2030. Those few survivors will control 75% of the market. Why so few? Local governments prop up failing brands to protect jobs, slowing down natural consolidation. Did you know China's car plant utilization dropped to just 50% last year? The lowest in a decade? Even top brands like BYD can't escape criticism. On May 23, 2025, Great Wall Motors chairman compared the EV market to Evergrande's collapse. That's a serious warning. BYD fired back saying, "I am confused and angry." What do you think? Healthy competition or signs of collapse? Analysts like Lei Xing say it's just too hard to manage such massive volumes without hitting big problems. As the price war enters its fourth year, automakers are looking abroad more than ever. So, next time you see a cheap electric car, ask yourself, is it a good deal or a sign of something bigger? China's auto price war reveals not just industry turbulence, but a global reckoning. From BYD's bold cuts to Neta's collapse, the landscape is reshaping fast. Overcapacity, rising debt, and unpaid suppliers signal deeper instability. Only a few brands may survive this shakeout by 2030. Curious how it unfolds? Subscribe now, share your thoughts in the comments, and join us as we track the twists and turns shaping the future of cars worldwide.